Good morning, everyone, and welcome to today's presentation on 1031 Exchange Basics. My name is Jeff Stechmann. I'm the Vice President over the Eastern region for Asset Exchange Company. Before we dive in today, I just want to kind of let everybody know how we're going to handle today's presentation. Don't feel like you have to write every single thing down, all right? Because today's presentation is actually going to be recorded, and you'll receive a link to today's recording if you want to refer back to any of the topics that we're going to discuss today. And then some of the topics that we're going to cover today, I have in just like single page PDF form. I'm going to email those out to everybody that's on the line today because, I find a lot of times, especially if you're a realtor and you have a client that has a 1031 exchange question, you really would love to be able to send them something via email. And the format that I send you the email in, you'll easily be able to pick and choose which PDFs are relevant to your client. If you want to include me in that email that you forward over to your client, that's great because, I'd be glad to answer any questions that they might have. You don't have to go about this alone. You don't have to be a 1031 exchange expert after today's class. I want to be a resource for everybody on the line today. All right, so just be on the lookout for that email after we finish up today's class. And then as far as questions go for today's presentation, I'm going to open the floor up to questions at the very end because I do find a lot of times if you do have a question, most often it'll be answered in an upcoming slide. But again, if for some reason it isn't, at the very end is where I'll open the floor up to questions. Now, let me give you a little bit of information about who I am. So I've actually been in the business for 30 years. I did a lot on the closing side of the business to get my start. Now, I'm originally from New Orleans. If you hear the accent come through, please forgive me. Every now and then it rears its ugly head. But I live in the Tampa Bay area of Florida, and I've lived in Tampa for 27 out of those 30 years. And, as long as I've been doing this, I've seen the really good times in the real estate world, and I've seen the really bad times as well. And, we'll see what this year brings to all of us, right? Now, kind of give you a little bit of information about who we are. So we're Asset Exchange Company. And now we've actually been in business since 2006. And over the course of our existence, we've done about 40,000 1031 exchanges, right? It's all that we do. We don't provide any type of closing services. We don't provide any type of financial services. Now, in the industry, we're known as a qualified intermediary, a QI for short. Now, depending on the area of the country that you live in, you may hear people refer to as an accommodator. Another common term is a facilitator, or just simply an intermediary. But again, most often, people just refer to as a QI. Now, our main job in a 1031 exchange is we actually hold the proceeds from what we refer to as the relinquished property. All right, so that's the property being sold in a 1031 exchange. We hold the proceeds from that sale on behalf of the seller, the exchanger. Right? Because the rule is they can never actually have receipt of those funds. Now, if they ever do, they would lose their ability to do a 1031 exchange. And we're going to talk about that in greater detail in an upcoming slide. But just a word of caution about QIs. It's amazing in today's heavily regulated real estate industry that at least on a federal level, there actually is no federal agency that oversees what we do. So what exactly does that mean for anybody out there, right? What that means is anybody can be a QI, right? There's no type of requirements. You have to have any type of E&O insurance. There's no type of requirements. You have to have any type of bond. There's no guidelines on where you hold the proceeds or the type of funds you hold the proceeds in. When you sit down and think about it, it's a really scary, scary thought. So, if anybody on the line today, if you're currently involved in a 1031 exchange, please just make sure you've done your due diligence and you're dealing with a reputable company. All right. I'll just leave it at that. All right. Now, great news when you deal with us, right? Well, we're actually based out of California. Now, our home office is in San Francisco, but because we're California based, the state of California actually has a state agency referred to as the California Franchise Tax Board. Now, that Franchise Tax Board actually oversees qualified intermediaries in the state of California. All right, they do require us to carry minimums for the E&O insurance we have, minimums for the bond that we carry. We're subject to audit by that franchise tax board. There's guidelines on the financial institutions where we hold the proceeds. There's guidelines on the type of funds we hold the proceeds in, which is great for anybody that deals with us in California, right? But any file that we work on, not just California property, any file that we work on in any part of the country, because, we handle 1031 exchanges all throughout the United States. Well, that franchise tax board has oversight in anything that we do. Because, as I mentioned, they could come into our office at a moment's notice and audit any file that we work on, not just California property, but anything that we do. All right, so you do have some assurances when you deal with us. Now, as far as our ownership goes, we're owned by two gentlemen, one of which is actually a tax attorney. Now, his name is Adam Skarsgård, and Adam is considered like a 1031 exchange expert. He's been called upon to testify in tax court as an expert witness on 1031 exchange. He even occasionally teaches at UC Berkeley on real estate and tax law, that type of thing. Now, the whole reason I like to bring his name up is because one of the things that we offer that, honestly, I don't know if any of the QI in the business offers is any of the exchanges that we're involved with. If for some reason they were to get audited, we would actually provide free audit support. All right, we'd work hand in hand with the client's CPA, helping to defend the audit, and it primarily would be done by our tax attorney owner, Adam Skarsgård. So again, another great reason to deal with us, right? Now, let's talk a little bit about the history of exchanging. So believe it or not, exchanging has been around for close to 100 years. And it really started back in the 20s with farmers. And back in those days, it was pretty simple the way exchanging worked. Maybe I had a farm that I grew corn. I knew another farmer, he had a farm that he grew wheat. Well, I wanted his farm and he wanted my farm. So we just swapped farms. And it was really that simple back in those days. But our modern day exchanges, kind of the format that we follow today, that was really started back in 1979. And there was a gentleman by the name of T.J. Starker. Now, Mr. Starker lived in California, and he owned all this land in California with timber on it. All right. So what Mr. Starker did was he sold that land to a timber company called Crown Zellback. And what Crown Zellback did is, in exchange for the land, they gave him what was referred to as exchange credits. And what Mr. Starker did with those exchange credits is, over the course of the next few years, he went out and bought various properties with those exchange credits. And that's really kind of how our modern day exchanges started, again, back in 1979 with T.J. Starker. All right, so if anybody on the line today, if you've ever heard of the term a Starker exchange, that's where it comes from. It comes from T.J. Starker's last name. I talked to some CPAs that have been in the business for, 30, 40, 50 years, whatever it may be. They still refer to a 1031 exchange as a Starker exchange. So again, if you ever hear that term pop up, that's where it comes from. It comes from T.J. Starker's last name, right? Now, when we talk about 1031 tax-deferred exchange, that name is actually derived from Internal Revenue Code Section 1031, right? And the code states this: no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such real property is exchanged for a property of like kind, which is to be held either for productive use in a trade or business or for investment. I get it. That's kind of a mouthful, right? Well, where the code states that property held for productive use in a trade or business. So you can do a 1031 exchange on any type of real property that you use in your trade or business, right? I'll give you guys an example of maybe the way that could work. So we did an exchange for a gentleman. He owned a daycare center, right? So he was using that real property for his business. So what he did was he sells the daycare center, does a 1031 exchange, and in his case, the property that he purchased as his replacement property, he went out and purchased another daycare center. Because why? Because he was going to use that real property for his business. All right. So again, any type of real property that you use in your trade or business, you can sell it in a 1031 exchange, and you can buy as a replacement any type of real property that you use in your trade or business. Right now, the next part of the code where it states for investment. So for investment, that could be something as simple as, let's say you own a single family residential home, okay, and you own it for investment. Well, how do you own it for investment? It's a rental property, right? You could take that rental property, you could sell that in a 1031 exchange, And then what could you buy as your replacement? Well, that's the next part of the code, like kind property. So what exactly is like kind property? Well, like kind property is any type of real property that you use in your trade or business or that you hold for investment. Okay, you can sell that in a 1031 exchange and you can buy as a replacement any type of like kind property, which is any type of real property that you use in your trade or business or that you hold for investment, right? So just because you're selling that single family residential home that you hold for investment, right, that rental property, when you sell that in a 1031 exchange, you don't have to buy as a replacement another single family residential home if you don't want to. Now, you can by all means if you do want to, but you could even go out and buy as a replacement, let's say maybe like a condo, a townhome, a duplex, a fourplex, vacant land. I mean, if you wanted to, you could go out and buy a commercial piece of property, a commercial strip shopping center, or a commercial office building anywhere in the United States. One of the high rises in any major metropolitan area of the United States. It doesn't matter if it's residential property or commercial property. Everything is interchangeable with 1031 exchange. You could also sell property that you use in your trade or business, and you could buy as a replacement investment property. Okay, that's also interchangeable. And you also are not even limited where you can sell and buy property. All right, you can sell and buy real property anywhere in the United States, including Guam, the U.S. Virgin Islands, or the Mariana Islands. Now, sometimes people will ask me, they say, well, Jeff, what about property in Puerto Rico? Can I use that in the 1031 exchange? And unfortunately, the answer is no, right? The reason being is Puerto Rico is under a different tax structure than we are here in the States. And that's why property in Puerto Rico is actually excluded from 1031 exchange, okay? If anybody on the line today, if you've ever heard of the term a like kind exchange, that's where it comes from. It comes from the part of the code that talks about like kind property. Now, as I mentioned, I'm located in the Tampa Bay area of Florida, right? So for all my Florida realtors on the line today, there's a standard real estate contract that Florida realtors use. It's referred to as the FAR bar contract, all right? In the FAR bar contract, there's already standard 1031 exchange language built into that contract. It's in section 18 and it's item N, okay? They actually refer to a 1031 exchange as a like kind exchange in that contract. So again, if you ever hear that term pop up, that's where it comes from. It comes from the part of the code that talks about like kind property. All right, now, what are current tax rates? Well, when you sell real property, if you have any gain in the property, you're going to be subject to capital gains tax. Now, capital gains tax right now is either going to be 15% or 20%. Now, the 15% capital gains tax rate is applied if you're single and you have income of less than $519,000 a year, or if you're married and you have income of less than $584,000 a year. All right, that's where you're at, the 15% capital gains tax rate. Now, the 20% capital gains tax rate is applied if you're single and you have income of greater than $519,000 a year, or if you're married and you have income of greater than $584,000 a year. All right, that's where you're at, the 20% capital gains tax rate. Now, in addition to the capital gains tax rate, you may also be subject to another tax. They refer to it as depreciation recapture tax. Okay, that's an additional 25% tax. You might be sitting there asking yourself, what is that all about? How does that work, right? Well, the depreciation recapture tax works like this. Any depreciation that you claimed in that property, for the lifetime that you've owned that property, when you go to sell that property, they're going to hit you with a 25% depreciation recapture tax on the entire amount of depreciation that you claimed for the lifetime that you've owned that property. Now, in addition to the depreciation recapture tax, you may also be subject to another tax. They refer to it as the Medicare tax. Another term you hear people refer to it is the NIT tax, the net investment income tax. That's an additional 3.8% tax. What's that all about, right? Well, the Medicare tax, that's something that they passed back in 2010 with the Affordable Care Act, Obamacare, right? It went into effect in 2013. Now, it was one of the things that they passed to try to offset some of the cost of the Affordable Care Act. All right. Now, the great news is when you do a 1031 exchange, you can defer having to pay any of these taxes. Now, what am I not listing up on the slide? I'm not listing anything to do with state taxes. All right, so for those of y'all that are located in a state like Florida, like me, um, that we don't have any type of state taxes, so you know what? We don't even need to worry about that. But if you live in a state or you're selling property that is located in a state that has state taxes, you'd also have to calculate whatever those numbers are, right? Great news again with 1031 exchange, you can also avoid having to pay whatever those state taxes are. Now, every state kind of has their own way of completing some type of form or going through some type of process in order to get out of having to pay those state taxes. I'll give you guys a couple of examples, at least on exchanges that I was personally involved with. So we did an exchange for a gentleman, right? He was a Florida resident, but he was selling an investment property in California. Well, guess what? California has state taxes. And I want to say their state taxes can be as high as like 11 or 12%. It's kind of like the more you make, the more they tax you. Now, even though he was a Florida resident, but he was selling an investment property located in California, guess what? California was still looking for their state taxes. Now, the good news for him was he was doing a 1031 exchange with us. He was going to be able to get out of having to pay those state taxes. And basically the way he got out of them was he had to complete the state of California form. He had to submit it to the state. That's how he got out of having to pay those state of California taxes. But it's my understanding that he's got to submit that form every year thereafter. The year he doesn't submit the form, they actually come after him for the taxes. Now, we did another exchange for a lady. She was another Florida resident. I believe she was selling property located in Maryland. Well, Maryland has state taxes as well. Now, good news for her was she was doing a 1031 exchange with us. She was also going to be able to get out of having to pay those state of Maryland taxes. And what they made her do was she had to complete the state of Maryland form. I think we even had to sign off on it. And I want to say she had to submit it to the state like 20 days prior to closing. And that's how she got out of having to pay those state of Maryland taxes. So again, every state kind of has their own way of completing some type of form or going through some type of process in order to get out of having to pay those state taxes. All right, now, I know we have a lot of realtors on the line today. You know, think about this for a minute. If that's your client, right, and you know that they're selling an investment property, especially if they're selling an investment property located in a state that has state taxes, and they're not talking about doing a 1031 exchange, that's a perfect opportunity for you to bring it up to them, right? Because if you can show to them and say, look, avoid having to cut that check or those checks, right, if they're subject to the state taxes, it's just going to give them that much more buying power to go out and buy themselves a better property. Now, hey, hopefully it's going to be a higher dollar property for them. Also, hopefully that's going to equate to a higher income producing property for them as well. And what is that going to do for you as a realtor as far as your commission goes? Hopefully you just increase your commission all by recommending a 1031 exchange, right? Because if they can buy that higher dollar property, again, hopefully you just increase your commission all by recommending a 1031 exchange. All right, so hopefully some things to think about for everybody on the line today, right? Now, I get this question, oh gosh, maybe about once a day. People will ask me, they say, well, Jeff, how long do I need to own a property for it to be considered an investment property? And the honest answer is I really just don't know, right? Because there's nowhere in the code that states how long you need to own a property for it to be considered an investment property, all right? The code just states it must be real property that you use in your trade or business or that you hold for investment. Now, you know, if you ask some CPAs, they'll tell you good rule of thumb is really to hold on to the property for at least a year, for 12 months. And really to rent it out for at least a year or 12 months, because if you just think about the logic behind that for a minute, right? It's 2025, right? So let's say you buy your investment property today, 2025, right? Well, and you're going to rent it out for a year, for 12 months. So what exactly is that going to mean? Well, what that's going to mean is on your 2025 tax return, you're going to report that property as an investment property, right? Because any income that's coming in from rents, you're going to report that on your tax return. Any expenses that are going out, you also are going to report that on your 2025 tax return. And remember, you're renting out for a year, right, for 12 months. So what is that going to mean? Well, on your 2026 tax return, you also are going to be reporting that property as an investment property, right? Any income that's coming in from rents, any expenses that are going out. So over 2 tax filing years, you would be showing to the IRS on 2 different tax returns, right, that property is an investment property. Is that a good rule of thumb? Well, the answer is maybe. right? Because if you ask some other CPAs, they'll tell you, no, really a good rule of thumb is you really need to hold on to it for at least 2 years or 24 months. Now, one of the reasonings behind that logic is back in 2008, the IRS came out with guidelines regarding vacation homes. And what they stated in the guidelines for vacation homes was for a vacation home to be considered an investment property, you must own that property for a minimum of 2 years or 24 months, right? So some CPAs pick up on that and they say, well, for a vacation home, the IRS is actually giving us guidelines stating for that vacation home to be considered an investment property, you must own it for at least 2 years or 24 months. Therefore, they're of the opinion any type of investment property, good rule of thumb is really to hold on to it for at least 2 years or 24 months. But the reality of the whole thing is it's not going to be so much about how long you own the property. It's going to be more so about your intent, right? And your intent could be something like this. Did you advertise the property for rent? Now, hey, did you advertise it for fair market value rent as well? Like, if fair market value rent is, let's just say $1,500 a month, and you're advertising it for rent for $5,000 a month, you know what? The IRS is probably going to have an issue with that. If you get audited and the IRS comes in and says, okay, prove to us you held that property for investment, you're going to have to be able to back it up. All right, now I list one particular court case on the slide. It's referred to as Resnick versus the commissioner. Now, in that particular court case, the circumstances was you had a husband and wife, okay? They owned a single family residential home that was their primary home, their primary residence. They also owned another single family residential home that was an investment property, a rental property, right? So what they did was they sell the investment property, they do a 1031 exchange, and the property that they purchased as their replacement property, well, they went out and purchased another single family residential home. That was going to be their replacement investment property. Now, during the 6-month period after they did their 1031 exchange, they ran a classified ad in the town newspaper that they lived in, advertising the property for rent at fair market value, okay? Now, they even showed it to 2 potential renters during that 6-month period, but for whatever reason, they could never get the property rented out. Now, what else happened during that 6-month period was one of them loses their job, right? So they had a mortgage in their primary home, but they also had a mortgage on that investment property, right? That wasn't rented out. So what they did was after 8 months of ownership, they wound up selling their primary home and they moved into the investment property, okay? In that particular court case, it was ruled that their intent for that investment property was to hold it as an investment. But what happened? Their circumstances changed, right? And they were forced to do something. So again, it's not always going to be about how long you own the property. It's going to be more so about your intent. And as I mentioned, if you ever get audited, you're going to have to be able to back it up. All right, so hopefully everybody remembers that point about investment intent today. All right, now, vacation homes. Boy, I always like to talk about vacation homes because why? I live in Florida, right? And here in Florida, it seems like either everybody has a vacation home or everybody wants a vacation home, right? So how does a vacation home qualify for 1031 exchange as an investment property? Well, this is actually referred to as Revenue Procedure 2008-16. And the first requirement I've already given everybody, you must own that property for a minimum of 2 years or 24 months. Now, for every 12-month period of ownership, you must rent that property out for a minimum of 14 days at fair market value. Okay, now you can use it for some personal use. Okay, you can actually use it for personal use for every 12-month period of ownership. You can use it for 14 days personal use or 10% of the total time that it was rented during that 12-month period. All right, here's an example of how that could work. Let's say during that 12-month period, you actually rent the property out for 200 days. Okay, so 10% of 200 would be what? Would be 20, right? You could use that property for your personal use for 20 days instead of the 14 days, okay? If that property meets those guidelines, it qualifies as an investment property, and hey, you can use it in a 1031 exchange. Now, if it doesn't meet those guidelines, I wouldn't necessarily say it would be disqualified. In that particular situation, I would recommend to the client, I'd say, look, talk to your CPA. And if you and your CPA can come to an agreement where you feel like you can justify the property as being an investment property, then hey, by all means, use it in a 1031 exchange, okay? We're always going to recommend to people, talk to your CPA. Because why? Because your CPA is going to have way more information about your tax situation than I ever would, that I would even care to ever know, right? Hey, if the CPA comes back and says, yeah, I feel like we can justify that property as being an investment property, then hey, use it in a 1031 exchange. All right. You remember, everybody, before we kind of dove in today, I told y'all some of the topics that we were going to cover today. I have in just like single page PDF form. This is one of them, right? I have one that just talks about the vacation home requirements, right? So again, that's going to be one of the PDFs that I'm going to be emailing out to everybody on the line today. So again, be on the lookout for that email after we wrap up today's class, okay? Now, what type of property is excluded from 1031 exchange? Well, your primary residence, your primary home, you cannot do a 1031 exchange on your primary home, your primary residence, okay? The good news for your primary residence, you may qualify for what they refer to as a Section 121, right? And in order to qualify for the Section 121, you had to have lived in that property as your primary home, your primary residence, any 2 out of the last 5 years. Right? And if you do qualify for the Section 121, when you sell your primary residence, if you have any gain when you sell it and you're single, the first $250,000 of any gain is tax exempt. And if you're married, the first $500,000 of any gain is tax exempt, right? You don't need anybody like me to help you with the Section 121. That's just something that you claim on your tax return in the year that you sell your primary residence. But again, primary residences, primary homes are excluded from 1031 exchange. Right now, property held for sale is also excluded from 1031 exchange. What exactly does that mean, right? Well, here's an example of how that could work. So here in Florida, we have a lot of these like national home builders, like Pulte Homes, Lennar Homes, KB Homes. Hey, let's say I'm Pulte Homes, right? Pulte is one of the largest single-family residential home builders in the entire country. They're a publicly traded company. They build newly constructed residential properties all throughout the United States, right? Well, the properties that they complete, when those properties are completed, what do they do with them? Well, they turn around and sell them, right? Because they're holding those properties for sale and not for investment, they can't do 1031 exchanges on those types of properties, okay? So again, property held for sale is excluded from 1031 exchange, all right? Now, a dealer property is also excluded from 1031 exchange. You may be sitting there saying, well, what exactly is dealer property, right? Well, dealer property might be somebody that we most often refer to as a flipper. They buy a property today, right? I don't know, 2 or 3 months goes by, and during that 2 or 3 month period, they fix their property up, right? And when that property is completed, what do they do with it? They also turn around and sell it. You can't do 1031 exchanges on those types of properties either, right? Because that's like their inventory. That's the business that they're in, right? They're in the business of buying properties, fixing them up. When they complete it, they turn around and sell them. You can't do 1031 exchanges on those types of properties. Now, here's a possible solution for a flipper. Again, let's say they buy a property today, right? 2 or 3 months goes by, they fix their property up. But when it's completed, okay, they go to their realtor and they say, hey, can you put this in the MLS system showing it for rent? Let's make sure we put it in there for fair market value rent as well. That's a little bit different, right? Because now all of a sudden, what are they doing? They're showing that their intent is to hold the property for investment and not for sale, right? I mean, I don't know, who knows? Maybe they even show it to a potential renter, right? They run some type of credit check on that potential renter. They don't have such great credit. They decide not even to rent it to that potential renter, okay? If that flipper ever gets audited and the IRS comes in and says, okay, prove to us you held that property for investment and not for sale, they're gonna have to be able to back it up. And the example I just gave you guys, I don't know, there's a good shot they could do that. They could say, look, here's an email that I sent to my realtor on such and such a day requesting that they put it in the MLS system for fair market value rent. Here's the MLS listing showing it for fair market value rent. Here's the day I showed it to that potential renter. Here's the credit check I ran on that potential renter. All of that type of stuff is going to be what? It's going to be their backup, their proof that their intent was to hold the property for investment and not for sale. Okay, but again, remember everybody, if you buy a property today and however long it takes for you to fix it up, when it's completed, if you turn around and sell it, you can't do 1031 exchanges on those types of properties. All right. Now, foreign property is also excluded from 1031 exchange. Here's a quick example of how that could work. Okay, so let's say I own an investment property located here in Florida. All right, so I sell it in a 1031 exchange. Now, I can't try to go out and buy a replacement property, let's say somewhere in Canada or maybe somewhere in Mexico or Europe. Okay, it has to be property located where? Anywhere in the United States, including Guam, U.S. Virgin Islands, or the Mariana Islands. So again, foreign property is excluded from 1031 exchange. Okay, now, what are the tax deferral requirements? Well, in order to get a full deferral, to defer your taxes 100%, okay, rule number one is you must reinvest all of the net proceeds in property of equal or greater value. What exactly does that mean, right? Net proceeds. That's the cash, all right? That's the cash that normally you would get out of the closing for the property that's being sold, the relinquished property, okay? Now, we're the QI, the qualified intermediary. We're going to hold those proceeds from that sale on behalf of the seller, the exchanger, all right? Because the rule is they can never have receipt of those funds, all right? If they ever do, they lose their ability to do a 1031 exchange, right? So they can't close today and call me tomorrow and say, hey, Jeff, I want to do a 1031 exchange. At that point, it's too late for them, all right? They couldn't even close today, walk out of the office of the title company, escrow company, attorney's office who did the closing, okay? Get in their car in the parking lot and call me from the car and say, hey, Jeff, I want to do a 1031 exchange, right? Because the company that just did their closing, they might be holding their funds in their escrow account. They might be waiting to wire their funds out to them. At that point, the client has what's referred to as constructive receipt. They have a legal right to the funds. They've lost their ability to do a 1031 exchange, right? So we have to get involved prior to the closing, basically prior to them walking out the door, right? Now back to the rule. What do they need to do with those proceeds that we hold on their behalf? Well, they need to take that entire amount, the net proceeds, and use that towards purchasing a replacement property, or you can even purchase multiple properties if you want to, where the purchase price or the combined purchase prices, if you do elect to buy multiple properties, must be at least equal to, or can even be greater than, whatever the sales price was on the property that was sold, the relinquished property, okay? That's rule number one. Now, rule number two is if you have debt that you're paying off, like a mortgage that you're paying off on the property that's being sold, all right? Whatever that payoff amount is, you actually are required to obtain an equal amount of greater debt in the purchase of any replacement property or properties, okay? Now, that rule can actually have an exception. If you have cash that you're willing to use towards buying your replacement property, you can offset that rule. All right. Now, obviously, if you have no debt, if you don't have a mortgage that you're paying off on the property that's being sold, the relinquished property, you're not required to obtain a mortgage to purchase your replacement property, but you do have the option if you need to or if you want to help you buy your replacement property. You can always go out and get a mortgage, get a loan to help you purchase your replacement property. Okay. Now, there's actually some timelines everyone needs to be aware of when it comes to 1031 exchange. Okay. So from when you close on your relinquished property, okay, from the closing date, you'll have 180 calendar days to purchase any replacement property or properties. And it's calendar days, it's holidays, that's weekends, okay? Hey, I live in Florida. And from June 1st to November 30th is what? It's hurricane season, okay? If there's some type of hurricane that's hitting and everything's shutting down for a day or two or a week, whatever it may be, none of that matters with 1031 exchange, all right? So please just realize that clock is always going to be ticking. Now, the first 45 days of the 180 days is what's referred to as the identification ID period. What exactly does that mean, right? Identification ID period. What that means is you must identify any potential property or properties you want to buy, all right? None of those properties that you identify even need to be under contract, right? You just have to identify any potential properties you want to purchase. That's something else that we're going to help with, all right? We're going to provide a form to the client. Now, we refer to it as the identification ID letter, But basically, it's going to have some blank lines on it, but it's going to have to be specific to a property address or addresses, okay? The client's going to have to fill that out, sign it, get it back to us by midnight of the 45th day. That's how they will formally identify their replacement property. They're going to do it directly to us, the QI, the qualified intermediary. Keep this in mind about the 45 days. Let's say they happen to find that perfect property, but it's day 46. Okay, at that point, it's too late for them. All right, so whatever they put on that form by midnight of the 45th day, they're going to have to make sure they're going to be able to purchase at least one of those properties, right? And when do they have to purchase it by? You have to purchase it by day 180, all right? There is no extensions to either one of the timelines. There is no exceptions to what you identify after midnight of the 45th day, all right? Let's just say you identify 3 properties, right? You put that on the identification ID letter, you get it back to us by midnight of the 45th day. Now, let's just say after midnight of the 45th day, one of those properties that you identified happens to sell. There's no going back and saying, hey, wait a minute. One of those properties that I identified, that property just sold. There's no way in the world I could ever buy it now. It does not matter. You'd only have the opportunity to purchase those 2 other properties that you would have identified. So again, no exceptions to either one of the timelines, no exceptions to what you identify after midnight of the 45th day, okay? Now, there's actually some rules to identifying. Now, there's 3 different rules, okay? I'm going to read each one of the rules to you. And if you don't quite understand them when I read them to you, don't worry about it, all right? I'm going to walk you through some really basic examples for each one of the rules to show you how the numbers work, right? And once I show you how the numbers work, hopefully it all makes sense to you, all right? So the most popular rule that we see investors enacting is referred to as the 3-property rule, all right? And the 3-property rule states this: you can identify up to 3 properties without regard to the fair market value of those 3 properties. So what exactly does that mean, right? Fair market value. Well, if you identify 3 properties or less, okay, the purchase prices of any of those properties can be any dollar amount. It does not matter as long as you identify 3 properties or less. Now, if you want to exceed the 3-property rule, you can do that as well with 1031 exchange, but it's going to put you into this next rule. Okay, it's referred to as the 200% rule. And the 200% rule states this: you can identify over 3 properties, but you cannot exceed 200% or 2 times the combined fair market value of the property being sold. What exactly does that mean, right? Well, if you identify more than 3 properties, okay, the combined purchase prices of all those properties that you identified cannot exceed 200% or 2 times whatever the sales price was on the property that was sold, the relinquished property, okay? Now, if you want to exceed the 3-property rule, and you also want to exceed the 200% rule, you can do that as well with 1031 exchange, but it's going to put you into this next rule. Now, it's referred to as the 95% rule. Now, it's very rare that we even see this in rule enacted. Honestly, it doesn't make a lot of sense in the way that it's written, but remember, everybody, it's the IRS, okay? And sometimes this stuff just doesn't make sense, right? Because it reads like this. You can identify over 3 properties. You can exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified. I know, I get it. That's probably about as clear as mud, right? Let me show you other examples of how the numbers work, especially with this 95% rule, and hopefully everybody at that point will get it, okay? So here we go. All right, so again, here's the 3-property rule. If you identify 3 properties or less, the purchase prices can be any dollar amount. It does not matter, all right? So here's a quick example. Let's say we sell our relinquished property. We sell it for $1 million, all right? Now we go out, we identify 3 properties, all right? Because we identified 3 properties, we're in the 3-property rule. Let's keep the math really simple on this one. Let's say we're going to be purchasing each one of those properties for $1 million each. All right, so how much have we identified in property? $3 million worth of property, right? Again, because we're in the 3-property rule, those purchase prices can be any dollar amount. It does not matter. I mean, we could be buying each one of those properties for, I don't know, $10 million each for a total of $30 million in identification. Again, as long as we're in the 3-property rule, the purchase price does not matter, all right? But what does matter? Well, I'll say it again. Boy, if you identify 3 properties, you better make sure you're going to be able to purchase at least one of those properties. Now, what's the best way to lock up a property? It's really to put one of them under contract. Now, again, for any of the rules, you're not required to have any properties under contract that you identify. But in practice, what we typically see investors doing is they will put one property under contract, and hey, that's one of the properties they identified. Now, I don't know, maybe they'll identify two other properties just as backup, because what could potentially happen at that point is after midnight of the 45th day, if the property that they do have under contract, if that whole deal falls apart, well, at least they have the opportunity to purchase those two other properties that they would have identified. All right, so hopefully everybody gets it, the three property rule. Now, here's the 200% rule. Again, this is where you exceed the three property rule, but you cannot exceed 200% or two times the combined fair market value of the property being sold. All right, so here's how it works. Again, we sell for $1 million. Now, in this example, we actually go out, we identify 5 properties. All right, because we identified 5 properties, what just happened? We exceeded our three property rule, right? So that's going to put us into the 200% rule. Okay, so what exactly does that mean, right? What that means is the combined purchase prices of all 5 of those properties cannot exceed $2 million. Now, you might be sitting there asking yourself, hey, where's he getting the $2 million from? Here's how I got it. All right, we sold for $1 million, right? So 200% of that $1 million sales price, or 2 times that $1 million sales price, is how much? $2 million, right? So I think this one is pretty straightforward. Hopefully everybody gets it. All right, now, here's the 95% rule. Again, this is where you exceed the three property rule. You exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified. All right, here's how it works. Okay. So again, we sell for $1 million. Now, in this example, we actually go out, we identify 10 properties. All right, because we've identified 10 properties, what just happened? We exceeded our three property rule, right? Now, let's keep the math really simple on this one as well. Let's say, hey, we're going to be purchasing each one of these properties for $1 million each. All right, so how much have we identified in property? $10 million worth of property, right? Because we've identified $10 million worth of property, what just happened there? We exceeded our 200% rule, right? Because that was how much? $2 million. So that's going to put us into the 95% rule. So let's just say in this example, we're only able to purchase 9 out of the 10 properties that we identified. Well, that's only going to equate to 90% or $9 million, right? That is not 95%. If we do that, if we're only able to purchase 9 out of the 10 properties that we identified, guess what's going to happen? We're going to blow our entire exchange and we're going to be subject to having to pay all of the taxes, right? So in practice, really the way the 95% rule works is really going to be 100% of whatever you identified, you're going to have to buy. And we're using really simple numbers, right? We're saying, oh, each one of those purchase prices are going to be $1 million each. You know what? In the real world, those purchase prices are going to be all over the map. It's going to be really hard to sit down and say, okay, let's see, if I buy this property, oh wait, that's only going to put me at 93%. Okay, let's see, if I purchase this other property, oh wait, that's only going to put me at 94%. Again, in practice, the way the 95% rule works is really 100% of whatever you identify, you're going to have to buy. All right, the IRS wants to limit you in how many properties you can identify. They don't want you going out there identifying everything under the sun, because you know what's going to happen if you identify everything under the sun? You're going to have to buy everything under the sun because of this crazy 95% rule. Again, we don't see it enacted that often, but everybody just realize it does exist and it is out there. Okay, now, how does the whole closing process work when it comes to 1031 exchange? Well, we don't even get the process started until there's a contract on the property being sold, the relinquished property, right? Because the way the process starts is I would need to get a copy of that contract. Now, I'd also need to get the contact information for the person that's handling the closing, and also, obviously, the contact information for the client, the seller, because what happens at that point is we're going to reach out to whoever's going to be handling the closing, right? And what we get from them is a copy of the title commitment. It's also known as the title search. Some parts of the country refer to it as the title, the preliminary title report, the title bonder, but basically it's the search of the title, okay? Once we have that in hand along with the contract, then what we're going to do is we're going to prepare what we refer to as an exchange agreement. All right, that'll be documents that will set up the 1031 exchange. Okay, we're going to email those documents over to whoever's going to be handling the closing. Those documents will sit there waiting for the day of the closing to happen. Okay, because what happens on the day of closing, seller's going to go in, they're going to sign those documents. Now, again, by them signing those documents, that'll set up their 1031 exchange, but that's also going to give us the ability to step into their shoes as the seller. And that's also going to give whoever's handling the closing the ability to take those net proceeds from that sale. They're going to wire those net proceeds over to us. We're going to hold them on behalf of the seller, the exchanger. All right. That transaction is going to take place. And then what's going to happen? The clock's going to start ticking, right? 180 days to close. The first 45 days of the 180 is the identification ID period. We're going to be sending out that identification ID letter. Client's going to fill that out, sign it, get it back to us by midnight of the 45th day, right? Now, once they get one of those properties under contract that they identified, we'll need to get a copy of that contract as well. And just like on their sale, we needed the contact information for whoever's handling that closing. It's going to be the same thing for their purchase, right? Chances are it's going to be a different company. Typically, it's not the same company that handled the closing on their sale. Because, you know, if you just sit down and think about it, we're going to be holding all their funds, right? We're going to need to have a contact person. We'll need to get from that company their wiring instructions, okay? We're going to prepare some other documents that we'll send over to that company. Those documents will sit there waiting for that closing to happen. Because what happens on the day of closing for that transaction, buyer's going to go in, they're going to sign those documents. Now, by them signing those documents, that's going to give us the ability to step into their shoes as the buyer. That's also going to give us the ability to take those proceeds that we would have been holding from their sale, and we're going to wire those proceeds over to whoever's going to be handling the closing to help them purchase their replacement property. That's it. That's the entire closing process, right? It's not that complicated of a process when it comes to the actual closings. The complicated stuff is what you see day in and day out in the real estate world. Negotiating contracts, getting pre-approved for a loan. Yeah, you know, the 45 days, that can be a little tricky sometimes, okay? But when it comes to the actual closing, that's probably the easier part of 1031 exchange, okay? Now, what do we actually charge for our services? What's our fee, right? Well, the most common type of exchange that we do, and it's everything that we talked about today, is referred to as a delayed exchange. Or another term you hear people refer to it is a forward exchange, right? It's everything that we talked about today. It gives you the ability to sell first, you sell your relinquished property first, and you buy last. You're buying your replacement property last, you're buying it by day 180, right? Again, that's the most common type of exchange we do. Our fee for the delayed exchange, we charge a flat $1,250, $1,250. Now, we don't charge any type of setup fees. We don't charge any type of wiring fees. You know, I just walked y'all through the entire closing process. As I mentioned, we like to get the process started when there's a contract on the property being sold, okay, the relinquished property. You know, we prepare the exchange agreement. We send those over to the company handling the closing. The documents sit there waiting for the closing to happen, right? If the closing never happens, if the contract falls apart, the buyer decides not to buy the property, or the client, the seller, decides they don't want to move forward with any type of 1031 exchange, we don't even charge any type of cancellation fees. Okay, our fee, that $1,250, is not incurred into the actual day of closing. Right? And the good news with our fee, it covers the sale of one property and actually the purchase of up to 3 replacement properties. That's it. There's no other hidden costs, hidden fees, anything like that. Now, there's a few other type of exchanges that we don't really have time to go into today because this is just a basics class. But there's another type of exchange. It's referred to as a reverse exchange, okay? It works just the opposite of a delayed exchange. It gives you the ability to buy first and then sell last. Buy your replacement property first, sell your relinquished property last, right? I got some other classes coming up later this month. Have an advanced 1031 exchange class, also a 2-hour discovering 1031 exchange class. I talk about that type of exchange in much greater detail in those those upcoming classes. So if you want to learn more about reverse exchange, please register for it. All right. The reverse exchanges, those start off at $8,500. All right. There's another type of exchange. Again, we don't have time to go into it today. It's referred to as a construction exchange. Another term you hear people refer to it is an improvement exchange or even a built to suit exchange. Okay. Again, I'm going to cover that type of exchange, those types of exchanges in additional classes, the advanced class and the Discovering 1031 exchange class later this month. But basically, the construction improvement or built to suit exchange, it actually gives you the ability to make improvements to a property before acquiring it. Okay, again, they can be significantly more complicated than a delayed exchange. Same thing with reverse exchange, they can be significantly more complicated. But for the construction improvement or built to suit exchanges, our fee starts off at $8,500 for those types of exchanges as well. All right. I'll go ahead and open the floor up to questions. If anybody has any questions, feel free to start typing your questions in. We're doing great on time today. And while we're waiting for questions to come in, there's a box that says questions. Feel free to type your questions in. As I mentioned, I have some additional classes coming up later this month, Advanced 1031 Exchange class, Discovering 1031 Exchanges. If you want to join in those classes, please feel free to register. The Discovering 1031 Exchange class is actually a 2-hour class. It covers everything that I taught today, also what I teach in the advanced class, and even additional information. Good news for any of my Florida realtors on the line today, it's actually worth 2 continuing education hours for your Florida real estate license number. So feel free, sign up for those classes, register for those classes. And a lot of these webinars, classes that I do for individual like real estate offices, boards of realtors, title companies. If you think any people that you work with in your office would benefit from me doing a class for you for your office, let me know. All right, I have some information I can send over to you guys. Talks about the various classes that I teach. If you're the decision maker, if you need to forward that on to the decision maker, please let me know. I'll get that over to you. All right, and also as I mentioned today, today's class was recorded. You're going to receive a link to today's class if you want to refer back to any of the topics that we discussed. As I mentioned in the beginning, some of the topics that we discussed, I have in just like PDF form, right? General information about 1031. I'm going to email those out to everybody on the line today, all right? Some of the information I even have in Spanish and Chinese. If you want those additional languages, please let me know. I'll get those additional PDFs over to you guys, all right? You don't have to go about this alone, all right? If you have a client that has 1031 exchange questions, if you want to take that email, you might want to pick and choose which PDFs are relevant to your client. If you want to forward that on to your client, include me in the email, introducing me to your client. I'd be glad to follow up with them, answer any questions they might have. If that works for you, it works for me. Obviously, how you handle your clients is your prerogative, but I just want to be a resource for everybody on the line today. All right. Okay. Let's see. Do we have any questions coming in? No, not yet. Let's see. All right. Somebody has a question. What happens if you don't find properties during the 45-day identification period? Well, if you don't identify any properties by midnight of the 45th day, okay, then come day 46, you would have failed your exchange and you'd be subject to having to pay all of the taxes. All right. The only thing you'd be out from us would be the $1,250 that we would have charged you when you sold your property. But if you don't identify any properties, you've lost your ability to purchase any properties after midnight of the 45th day. Okay. So you would on day 46, your exchange would have failed, and you'd be subject to having to pay all of the taxes as if you didn't even try a 1031 exchange. Okay. All right. Let's see. Could they file paperwork to extend the 45 days? No, there is no extensions to the 45-day timeline. Okay. If you do not identify any properties by midnight of the 45th day, you will fail your exchange and you'd be subject to all the taxes. Okay. All right. Another question. Can an unimproved property be used to purchase a house to use as a short-term rental? Unimproved property be used to purchase a house to use as a short-term rental. Unimproved, like maybe like land, something like that. Is if it's unimproved, I guess you could do that. I don't know how it would be a short-term rental if there's no improvements to the land. But yeah, land would qualify. you know, I guess that's your question. Hopefully I cleared it up for you. If you want to be a little bit more specific, let me know. And you can shoot me an email offline. If you have a question that is a little bit more complicated to type into a box in like 20 seconds, I totally get that. Right? Just shoot me an email offline. My contact information is up on the screen. That's my office line. You can always give me a call too. All right. Let's see if there's any other questions coming in. Okay, somebody has a question. My customer wants to do a 1031 exchange with a buyout of an investment property, not the sale of the property. Is that possible? You want to do a buyout of an investment property, not the sale. 1031 exchange is only for real property. Okay, if there's no sale occurring, then you can't do a 1031 exchange. If that's what you're asking, my customer wants to do a 1031 exchange with a buyout of an investment property, not the sale of the property. Is that possible? I'm not 100% sure what you're asking. You can only sell real property in a 1031 exchange. You can only purchase real property in a 1031 exchange, right? If you can be a little bit more specific, I'd be glad to answer your question for you, but I'm just not totally understanding what you're talking about. Sorry. Do they have to ID 3 properties? No, you don't have to ID 3 properties. You can ID 1 property on your form. But again, if you only identifying 1 property, that's only if it's after midnight of the 45th day, you're locked into buying that 1 property. You don't have any other options if that's all you identify. All right, let's see. Okay, here's another question. The real property is not being sold. She is being bought out. Okay, that's the question about there's no sale occurring. She's being bought out. Gosh, I don't know. I'm still a little confused. If that person wants to sell them their property, if it's some type of partnership or something like that, you're saying being bought out, that doesn't work with 1031 exchange. You have to purchase real property. Okay. Again, Maria, we could talk offline if I'm not totally getting it. Again, I know it's kind of hard to type into a box in like 20 seconds, but we can talk offline if that just makes it a little bit easier for you. Here's another question. Is 1031 restricted to properties that are self-owned or LLC? No. Any type of legal entity can do 1031 exchanges, LLCs, partnerships, trust, individuals, obviously, husband and wives. Okay, we cover that specific topic in my advanced class and also in my my Discovering 1031 Exchange class. Okay, so but any type of legal entity, individuals can do 1031 exchanges. They can sell the property. They can buy replacement property. Okay. Okay, if an LLC has 2 partners, only one wants to move on the 1031, what's the solution? That's something that we cover in the additional classes, okay? But the thing with 1031 exchange, whoever the taxpayer is in the sale always needs to be the same taxpayer in the purchase of any replacement property or properties. If the LLC has partners, okay, that's the LLC is the taxpayer. That's referred to as a regarded entity. That LLC has to do the 1031 exchange. That same entity has to purchase the replacement property because the individual partners don't own the property. The entity does, right? The entity files a separate tax return, right? Because it has partners, right? That entity is the taxpayer. That same entity has to purchase the replacement property. There is a possible solution. I don't have time to talk about it in today's presentation. Give me a call and I can maybe walk you through some other solutions that maybe we could figure something out for them, okay? Okay, another question. What happens if the client uses less than the net profits with the replacement property after using 1031 exchange? We're going to cover that in my class, in the advanced class, and also the Discovering 1031 Exchange class. All right. Again, today's class was just a basics class. But if you don't, if you don't use all the proceeds towards buying replacement property, you're going to be subject to taxes on whatever you do not use towards buying the replacement property. They refer to it as boot. It's actually referred to as cash boot. Again, we don't have time to go into it today, but I do cover that specific topic in my upcoming classes. All right. All right. Okay. I think that's it. All right. Well, we had some good questions today. And again, if you have other questions, just shoot me an email, give me a call. We can talk offline. But I'll go ahead and wrap it up for today. Appreciate everybody joining in. Hopefully you learned something about 1031 exchange today. As I mentioned, you don't have to go about this alone. I want to be a resource for everybody on the line today. If I can answer any questions you or your clients might have, please let me know. Okay. Again, thanks for joining. Please stay safe, stay healthy, and hopefully we'll talk soon. Have a great day, everyone. Bye-bye.